Imagine you just finished a grueling month at work, slaving away at your job. You get an email confirming you've been paid a gross total of $2,000. But when you finally check your bank account, only $1,456 actually landed. Your pay stub reveals a modern ritual, giving away a massive chunk of your earnings to invisible forces: federal income tax, state tax, Medicare. We pay these deductions as the required toll for civilization, so the government can build roads, fund schools, and make sure your local taco truck isn't infested with rats. You assume the money you kept is safe once you hand it to a bank teller. You picture it sitting in a secure vault somewhere, guarded day and night. In reality, that money is already gone. Then you encounter the third drain on your cash. You buy your usual bag of chips at the store, and suddenly the exact same bag costs 30% more than it did last month. The cash you managed to hold on to is quietly losing its purchasing power. To stop losing your wealth, you have to look past the physical paper and master the human-made rules of this invisible game. The entire system rests on a strange reality. Fiat currency has no inherent physical value. We only treat a paper dollar differently from a random stick because society collectively agrees the paper is worth something. It is a shared illusion of trust. Because money is just a unit of trust, actual wealth is generated by creating something people perceive as valuable. When someone like Steve Jobs creates a massive amount of utility, millions of people willingly trade thousands of dollars for that value. Banks manage the flow of that trust. This diagram shows exactly how fractional reserve banking operates. When you deposit $1,000, the bank is only required to keep a tiny fraction of it on hand, say $100. They immediately act as a matchmaker, taking your other $900 and loaning it out to someone who wants to buy a jet ski. The system operates efficiently, but it carries a fatal structural flaw. It relies entirely on the assumption that everyone won't show up at the exact same time asking to withdraw 100% of their cash. When that trust breaks down, the results are immediate. In 2008, panic drove people to line up outside institutions to withdraw everything they had, evaporating reserves and causing the system to crumble. Because the whole structure depends on money being reliably paid back, lenders use a strict metric to measure you. Your credit score is a shadowy 3-digit algorithm tracking your payment history and debt levels, designed to predict if you can be trusted. The modern economy doesn't operate on piles of gold sitting in vaults. It operates on a fragile web of institutional trust, and your ability to borrow depends entirely on how reliable you look to the gatekeepers. As money flows through this web, its value constantly shifts. Inflation occurs when money slowly becomes less valuable over time. This happens when too many people have extra cash, and they all try to buy the same limited supply of goods. This diagram illustrates the basic math of supply and demand. If 2,000 people crowd a store trying to buy a TV, but the store only has 1,000 units, the business naturally responds to the frenzy by raising the price tag from $500 to $800. The government can directly trigger this imbalance. When a central bank decides to print too much physical currency, they flood the market with cash, effectively turning your hard-earned dollars into monopoly money. When spending gets out of hand, the government forces a painful reset called a recession. By raising interest rates, they make borrowing much more expensive. People stop spending, businesses cut costs, and jobs vanish, causing the economic party to come to a sudden halt. Those interest rates dictate the cost of participating in the economy. At its core, interest is simply the price tag for renting someone else's money to use today. Look at how this model tracks compound interest on a credit card. While simple interest is a flat fee, compound interest means your debt starts earning its own debt. If you miss a payment, a small $12 lunch quickly multiplies into a $50 regret. This same math turns into an engine for growth when you invest. As this timeline shows, your wealth duplicates consistently over time, turning $100 into $400 while you sleep. You have no control over national inflation rates or sudden recessions. However, compound interest is the mechanism you can control. Depending on whose hands the money is in, it will either operate as your worst enemy or your best unpaid employee. The math of this system is blunt. If you leave your cash sitting idle, inflation will consistently punish you by eroding its value. The structure is built to strictly reward patience and market participation. The final variable in escaping this cycle is time. Everyone starts with a finite supply, but the default setting for most people is trading their hours directly for a linear paycheck. 1 hour of labor equals 1 fixed payment. Wealthy individuals break that linear equation. Instead of trading hours, they trade their money for ownership slices of growing companies, bonds, and real estate, acquiring assets that generate value without requiring their physical labor. Putting your money into the market carries inherent risk. Values constantly fluctuate, but the true danger is keeping your money out of the market completely, allowing inflation to slowly, predictably steal your future purchasing power over decades. You will never avoid taxes, bypass economic crashes, or change fiat currency rules. But once you understand how these invisible forces interact, you can leverage time and compound growth to finally rig the game back in your favor.